Berkshire Hathaway doesn't really have a team of managers, professional managers, that it can deploy to improve a business or turn it around. So he needs a business that's already well run. And so he looks for managerial integrity and reputation and skill. So those things have been the same throughout his acquisition life, despite changes in size and changes in market.
On Wealth Track, how has Warren Buffett's investment approach changed over the years?
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Warren Buffett has been writing his now famous annual letter to shareholders since 1979, when Berkshire Hathaway was first listed for trading on the NASDAQ. Back then, the stock had one share class, the A shares, and was trading at under $300 a share. Today, the shares are trading at over $600,000 a share, around a 240,000% gain. The less expensive and more widely owned and traded B shares were issued in 1996 at close to $20 a share. They now trade around $400 a share, a slightly more modest 1,600% gain. There have been numerous investment changes over the years. Entire companies bought and kept. As Buffett says, once acquired, his goal is to own a company forever. And there are sizable stakes in other companies bought over the years, mostly through stock purchases and occasionally sold. This week's guest has been analyzing and monitoring these changes and many other Berkshire developments since 1995 by compiling and organizing Buffett's annual letters to shareholders in the form of a book with Buffett's approval and input. He is Lawrence Cunningham, the author and editor of the now classic best-selling book, The Essays of Warren Buffett, recently published in an 8th edition. Cunningham has organized topics covered in the shareholder letters over the years in 10 themes: governance and management, investing, common stocks, alternatives, acquisitions, valuation, accounting, taxation, history, and finally CODA, concluding remarks by both Buffett and his late business partner and Berkshire Vice Chairman Charlie Munger. These are comments they have made in recent shareholder letters about Berkshire's future with or without them. And that is a topic of part 2 of our interview with Lawrence Cunningham. I began this interview with what hasn't changed at Berkshire, what he calls his owner-related business principles. I asked Cunningham what that means.
Warren invented this idea of ownership and an owner-related business principle because he had been running a partnership for many years, and he knew every investor personally and gave an accounting to them and explained things to them. They learned from him, trusted him, and he wanted to keep that partnership attitude alive even as the company was a publicly traded company with shareholders who may or may not be part of that knowledge group. And he wanted to attract to Berkshire Hathaway investors who were interested in learning and being partners and being treated like partners and feeling like partners. And so to guide them, he produced this very short, sweet set of 15, he called them owner-related business principles, as a compact, a sort of constitution between what he was going to try to do and what he expected his partners, the owners, should want to do.
What were some of the main principles?
Well, the first one said, and still says, though our form is corporate, our attitude is partnership. And he explained just what I just did, that he wants to be just one among equals. There's no hierarchy here. He's not in charge. I mean, he has responsibilities and duties. He'll be allocating capital, but he's on the same page as you. He's not getting any stock options. He's not getting any perks. He's your partner in this venture. Another example of that is candor. He says, I will report to you all the information that I would want if our positions were reversed. So he's very candid, what we're doing, why we're doing it, what things went well, what things didn't go well, the mistakes that they've made. Another piece of this, a later principle, is a commitment to permanence, that partnerships typically are formed forever. And he wants people who buy into Berkshire to feel that way too, to buy the stock with the intention to hold it forever, not to sell it. And he takes the same approach with the investments that Berkshire makes. So they buy wholly owned companies and virtually never sell them. They buy stocks and prefer never to sell them. Sometimes they have to for various reasons, but he's committed to permanent ownership of the investments Berkshire makes, and he would like to have investors, owners of Berkshire Hathaway, who have that same commitment to permanent ownership of Berkshire.
So it's kind of an investor education, a shareholder education course of this is the way we see our job at Berkshire Hathaway, and are you going to sign up for this or not, or know what you're signing up for, right?
That's exactly what it is. He started doing this in 1979 after they'd been public, and he analogized companies to restaurants offering different cuisine to different clientele. So there's French gourmet, there's fast food, there's smorgasbord, and whatever the restaurant is serving, different kinds of people will come. And he thought, companies are like that too, or at least this company is. And so we are going to try to get that partner owner interested in understanding the business, focus on this business, and staying with us through thick and thin. And that is the reason he spent so much time over all these years writing these letters to try to attract that kind of shareholder.
Did it work?
It did work, and you can measure it in a lot of different ways. One of the best ways to measure it is the average turnover in the shares of Berkshire stock compared to other comparable companies. It's far lower. And that's still true here in 2024, when you've got a much more very active stock market, a lot of short-term trading. Berkshire Hathaway's shareholders still tend to hold far longer than the average. Buffett called them high-quality shareholders.
You are a leader in the quality shareholder movement. You've got a consultancy on quality shareholders, and you've written a book about it, which you and I have talked about on Wealth Track a couple of years ago. You have organized the essays of Warren Buffett in themes that have been mentioned in his annual letter over the years since that first annual letter, shareholder letter in 1979. At the last page of the book, The Essays of Warren Buffett, you've got this neat graph that organizes by themes and the different letters that actually talk about these different themes. So I from the point of view of an investor, I'd like to talk about the different themes and the clusters of years when Warren Buffett has mentioned these different themes and why that's the case and why they've been important in different periods. So, for instance, he talks about investing in the 80s and 90s a lot.
I think he was very committed to explaining his views on investing in that period to educate his shareholders about his approach to investing, which is focused, fundamental, company by company investing. During that period, many rival theories of how markets work and how investors ought to think were fashionable, and including from the universities had put out this idea of efficient markets, which told people, the market is so smart, you can't pick a stock that's underpriced. And Buffett had spent his career picking stocks that were underpriced. So I think he felt that it was important for him to educate his shareholders in a way that the business schools were not educating students. And so he spent a lot of time during those periods articulating what it means to be a fundamental, focused, analytical investor, picking stocks, picking individual companies, and how to identify its competitive advantage, what he called a moat that would help, and how important it is to think about whether a company's moat will enable it to deliver sustained returns on invested capital for very long periods of time. He also emphasized the importance of having managers of that company with high integrity, so that they would feel as stewards of shareholder capital, so that they deliver the returns on that capital to the shareholders rather than siphoning it off into executive compensation or just empire building or other corporate adventurous. And I think having done that for those 20 years, he had essentially written the textbook. There was, I mean, he'd occasionally add paragraphs over the next 10 or 20 years, but most of the fundamental principles he had articulated and laid out, didn't feel the need to keep explaining it again and again.
Valuation during the 80s and 90s was also a big topic in the annual letters. Just to tell us some of the things that he said about valuation.
He identifies a concept called intrinsic value, and he distinguishes that from market price. Again, those academic theorists were often trying to say that market price is value. And Warren tried to explain that it may or may not be, that the real value of any asset is the cash flows it can be reasonably expected to produce from now until the end of time, discounted back to the present value. And he said that's the intrinsic value of any asset. So if you're thinking about a stock or a farm or an apartment building or a company, that's all you need to do is try. It's going to be complicated, but that's the simple reality is picture those cash flows, discount them to the present. That's value. That's intrinsic value. And he said the market may capture that in price, but it may be exuberantly high or depressingly low. If you're looking at other investments in commodities or derivatives, it gets even harder. And he put a lot of effort into explaining the application of that valuation model to lots of other asset classes too. Again, all for the benefit of to educate his shareholders of how he's thinking, and so they could feel that partnership.
So speaking of other assets, I mean, he also devoted a great deal of words to alternative investments, and not necessarily in a favorable light, but from 2002 to 2009, you again identified that was a theme that was frequently came up in those annual shareholder letters. Gold and hedge funds and private equity got a lot of attention.
Yeah, it's a really fascinating section of the book, and it gets into graduate level learning. What we're just talking about is mostly about stocks and valuing them and related assets. This is more advanced. Gold, private equity, hedge funds. He actually, gets into some of the exotic financial arrangements that were made that
global
led to
financial
the
crisis.
global
Right.
financial crisis of
Yeah.
08 and 09. So he's talking about these topics because they were in the news. People were talking about them. His shareholders were reading about them. And so, with gold, for example, he spends a lot of time explaining that gold doesn't have many practical uses. It's a store of value that becomes very attractive to lots of people when people are fearful, when people are scared that the economy is tanking, that it's hard to find businesses to invest in. People buy an ounce of gold or tons of it in order to have this store of value. And he explains that may be a very dumb idea because it's not going to increase in value. You take that bit of gold, it's just going to sit there. It's not going to do anything. Where if you buy a farm, it's going to produce. You buy an apartment building, it's going to produce. So he's trying to explain, while others are fearful in buying gold, I'm going to be buying stocks and companies with your money. And after that 08, 09 crisis, I think what he wanted to do, he, again, addressing his audience, and looking at what they're reading in the paper every day, what they're talking about with their friends, is how did this happen? How did we get into this situation where all these financial institutions were frozen and needed these enormous bailouts? How did that happen? And so you have to go back to some fundamentals, and he teaches us about, well, here's how real estate gets valued, and here's how loans are made against that real estate, and here's what can happen when banks get over leveraged in those loans and prices are going up and up and up, and then there's a collapse and a correction, and tries to take a step back as well to comment on our culture, on the appeal of the American dream and home ownership, and why, despite all of that havoc and all of the turmoil, don't give up your dreams, don't give up your hopes. He's like Uncle Warren. He was just trying to explain things in a very rational and sensible way, while a lot of people were losing their minds over the crisis.
But has his approach changed over the years as far as, I'm thinking another topic that came up frequently in the 80s and 90s was the topic of acquisitions. So what were his guiding principles there, and have the kinds of companies that he has purchased, it's a diverse portfolio, 80 different businesses at Berkshire Hathaway, has that changed or evolved over the years?
I think it has evolved on a couple of different vectors. One is the simple matter of size and scale. Back in the early days, Berkshire's acquisitions tended to be for an equity value of in the hundreds of millions. Buying a uniform company, buying an air compressor company, buying a box chocolate company, hundreds of millions of dollars. And so as the company scaled in the billions and the tens of billions, you see pretty steadily the size of the typical acquisition rising. They still make some of those small acquisitions. They made a $500 million acquisition just 5 years ago, so they still get those. But in terms of scale, it really rose. And at this point, in order to move the needle at Berkshire, they would need to deploy many, many tens of billions of dollars. And so that's one big thing that's changed. The other thing is that acquisition markets do move in trends or
Right.
Practices change. And so back in the 80s and 90s, when there were a lot of hostile takeovers, Buffett's attitude was, I don't do hostile takeovers, but he was very happy to invest in the preferred stock of companies who wanted to resist hostile takeovers, and he played the role of a friendly partner. They called them, back in the old days, a white knight or a white squire. So he did that at Salomon Brothers, Washington Post earlier, at Gillette, at Champion. And so during that period, he was providing a valuable service to those partners, and that's how he saw his investment with them, and receiving compensation for his investors. So you're receiving a high coupon preferred stock. That doesn't happen much anymore. The phone's ringing more often. He's starting to get very interesting opportunities from his network of friends, and acquired some wonderful private companies that way that were just spectacular.
Such as?
Yeah, the Marmon Group, maybe the biggest and most spectacular. It's a diversified industrial conglomerate founded and created by the Pritzker brothers out of Chicago. It's just a wonderful company. But Shaw Industries, which is a maker of floorings and carpets from the Shaw family. So the sort of the acquisition environment may change a little bit. What he looks for remains the same. He looks for that business with a competitive advantage, a moat that will enable it to deliver sustained returns on investor capital for long periods of time. And then the other big thing is integrity of management.
Right.
When they make an acquisition, unlike a lot of buyers, both strategic and financial, who have a group of professional managers that they then use to take control of the company, Berkshire Hathaway doesn't really have a team of managers, professional managers, that it can deploy to improve a business or turn it around. So he needs a business that's already well run. And so he looks for managerial integrity and reputation and skill. So those things have been the same throughout his acquisition life, despite changes in size and changes in market. And he's got, in the essays, you'll see a section that says, here's what we're looking for. And he'll have, I think there's 6 acquisition criteria. And one of them is size. He always has had a minimum. Even in the old days, it used to have a certain minimum, and today the minimum is a lot higher. But it's these things like it's got to have a competitive advantage. It's got to be well run. We can't supply the managers. Another thing that's on that list is it's got to be something that he can understand. It's a very important concept to him called the circle of competence. And again, this is a lesson he's trying to teach his shareholders too, that you should be self-aware enough so that you know what you're good at understanding and evaluating, and focus on opportunities in that set within your circle of competence, and be very careful of getting outside of those boundaries into places where you just don't know enough to decide rationally whether something makes sense. And he has historically claimed that his circle of competence stops at high technology. He thinks, look, that it's too fast paced for him. It's hard for him to predict with any degree of comfort what the cash flows will be in 3, 5, or 7 years. So he has generally stayed away from that space. But those are the acquisition criteria, and they have not changed.
So from an investment point of view, many of us read those letters, and because you can learn so much from them. Are there 2 or 3 lessons for investors of how we should invest as well? And has anything changed since the 1979, the first annual shareholder letter, that in Warren Buffett's investment approach that we can learn from?
Yeah.
Well, I think one of the key things that investors should learn is permanence. Earlier, we talked about how his view of Berkshire as a partnership is really aligned or committed to the idea that I plan to be here forever, and I hope you plan to be here forever too. And that holds for your investment in Berkshire and certainly Warren's investment in Berkshire and the investments that Berkshire makes. Why is that valuable? Why is that useful to people? Well, because trading is costly. Short-term holding periods cost money. A transaction costs that you pay the broker to buy and sell, and then the tax of the gain or even a loss. And so there are frictional costs, and then just all of the time, energy, and attention, the mental preoccupation with things that you're focused on. How has the stock performed, and is this a good time to sell or buy it? So his view is, if you can just step back and just make a few good decisions, a few good selections, and then stick with them, hold them for a long period of time, you will do better. And that lesson of permanence comes up again and again and again throughout the essays, in talking about the value of compounding, the value of deferring taxable gains on appreciated stock. Berkshire has owned some of its investments for many, many decades, and so the unrealized gain on some of its holdings is in the tens and tens of billions, maybe more. And he's got a wonderful essay explaining that he doesn't have any problem paying taxes. Berkshire pays an enormous amount of taxes, but the way our tax system works, the government is willing to be a partner in our investments, and we will pay them eventually. But for now, they're giving us an interest-free loan on these funds. So that's, I think, the animating theme for investors. And I guess a related one is he guides his investors against paying brokers and agents and advisors and so on. And I think he's willing to say, look, if you can follow the concepts I've described, focusing on a company with a moat led by managers with integrity, and then be willing to buy it and hold it for the long term, you'll probably do pretty well. If you're unwilling to follow those steps or unable to identify stocks, you say this investing is just not part of your circle of competence. For that group, his advice is buy an index fund.
I have one last question for you, Larry. The one investment for a long-term diversified portfolio, what should we all own some of?
I like Post Holdings. A very interesting company. It has a lot in common with Berkshire. It approaches the business, Raisin Bran and other and snacks and cereals. That's the company. You'll see them, in the grocery aisle. You'll probably recognize them. But they have a lot of different businesses, and they tend to be operated by independent, autonomous managers who are given a lot of responsibility, and they're selected for their integrity. They have an owner focus too, much like Buffett. They're always trying to deliver sustained returns on invested capital to stockholders.
Great. Thank you, Larry Cunningham, so much for joining us again on Wealth Track, and I look forward to talking to you for another program. Thank you, Larry.
Thank you very much, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is read the most recent 8th edition of the Essays of Warren Buffett by Lawrence Cunningham in collaboration with Warren Buffett. Buffett calls it the best book representing my views, a great job collating our philosophy. And in classic Buffett fashion, a lot easier to read than all the annual reports. First published privately for an investment symposium organized by Cunningham in 1995, which was attended by Buffett, the essays have been updated periodically with Buffett's approval to reflect his thinking since Berkshire's first annual letter to shareholders was published in 1979. The essays are organized thematically on a wide range of business and investment topics. The essays also include Buffett's perspectives on taxation, American history, and Berkshire's culture. The Essays of Warren Buffett is a fascinating, entertaining, and easily understood collection of this great investor's thinking over the years. There is a reason it's become an investment classic. Well, next week we analyze the outlook for Berkshire beyond Buffett and now without Munger in part 2 of our interview with Lawrence Cunningham. In this week's extra feature, Cunningham shares what it's like working with Warren Buffett over 3 decades. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a superb weekend and make the week ahead a healthy, profitable, and productive one.